All right, so this week we got an additional data point coming out of the hyperscalers. This time it was Microsoft and then Amazon yesterday. And I want to title this entire presentation or this entire take on the earnings as quality versus growth at any cost, because that seems to be the tug of war that the market is going under this time around of the year. Now we are entering into the October seasonality for the VIX, where it tends to peak and most of the market drawdowns come about. So as you've been seeing from the morning digest out of the Offside newsletter, there seems to be that tug of war between concentration into AI, growth at any cost, and then some days, plenty of days this week, in fact, we have a rotation back into quality, back into cash flows, back into value. That's what you see. Names in the software space, names in the real economy, the Halo thesis that I've been posting about outperform for the day. Now, I want to cover the divergence between the two companies here, Microsoft and Amazon. Even though they both rallied on earnings, the underlying figures looked very, very different. And first of all, we're going to cover the regime. So right now, as I mentioned, there's the tug of war between growth at any cost, regardless of the quality, regardless of the financial statements. And some days we get a rotation back into bulletproof balance sheets, cash flow, and high quality earnings. Now, Microsoft is obviously on the camp of quality, free cash flow generation, and keeping things neat. Amazon, on the other end, like Oracle and like Google, are choosing to pretty much report their finances through aggressive accounting measures. And we're going to get into those in this presentation. Now, the tell has to do with the accounting statements when you strip out those aggressive measures and how these stocks reacted, pretty much the price action to those earnings as a relation to what the market did on that day. I don't know if you caught the fact that these names reported on pretty much different days for the market. So on Wednesday, Microsoft reported on a day that the market rewarded and bid quality and value. So that day, the memory stocks, the semiconductor stocks sold off hard. That was the day pretty much when the capitulation out of the Leopold Schrenbrenner, I think it's the last name, it's pretty tricky, but you all know that story. Citadel bailed out the Situational Awareness Fund and pretty much bid the entire market yesterday, right? Thursday. So on Wednesday, the market cared about quality, cared about value. So Microsoft reported and popped on that sentiment. Now, the earnings were pretty strong. I really liked the numbers that I saw. I covered the entire thing inside a newsletter post. But I think that it was both the merit of Microsoft and the tailwind coming out of the market preference for that day and the regime. Now, yesterday and Thursday, obviously the news of the Citadel bailout and rescue of situational awareness created a bid for growth at any cost, and regardless of balance sheet strength or quality. And by coincidence, Amazon reported after the bell. So obviously, this was both merit from Amazon, but also tailwind from the market regime. And we're going to get into why in a minute. So free cash flow is the most important number in the filings, right? These financial metrics command the flexibility financially for these companies to pay down debts, to adapt to changing market conditions, to react to new competition coming into the scene. Without free cash flow, that goes out the window. So if the token economics were to change, the cloud computing demand, the memory demand, and pricing were to change, companies like Amazon and Google are not able to react as quickly as a Microsoft would because of the free cash flow. Now, apart from that, as a shareholder, you want to have free cash flow compound over time, because that's when you get benefits. You get benefits like share buybacks, you get M&A activity, and you get that flexibility that reflects itself in lower volatility for the stock. So most of these hyperscalers and a magnificent 7 names, they got to the premiums and the high price action they represent because of the underlying ability to generate free cash flow and compound that free cash flow. So when you remove that, obviously the volatility goes up and the quality of the stocks go down. Now, on the surface, these are the hyperscalers, so of course, the ones doing all the big spending. But here's a different animal when it comes to Microsoft. So, first, capital allocation. They are spending aggressively on AI. They boosted the capex for the quarter, they boosted guidance for the end of the year in 2027. They also saw healthy customer concentration. So, uh, Oracle could be one example. Oracle has over 60% of their backlogs concentrated toward OpenAI. Microsoft has roughly 30%. So, still a pretty good chunk of the book, but not enough to threaten the entire company, such as it did for Oracle, because the 60% that Oracle has concentrated into OpenAI represents roughly 200% of the company's market cap. So if Oracle doesn't pay, OpenAI doesn't pay, Oracle goes under. If OpenAI doesn't pay, Microsoft could have 10-15% of its market cap cut. And at this point, given the severe drawdowns from the highs, I believe it is all priced in. Now, all of that, despite the spending, despite being exposed to OpenAI in a very small way, cash flow quality is still paramount. It is still bar none, right? The reason for this is that they are spending below the cash flow generation. So they are still cash flow positive. In fact, they returned $10.2 billion to shareholders the last quarter. So even though they're spending more, even though they're taking on a little bit of debt to finance the capex they're doing for Azure and everything else that's commercial cloud computing, they're still cash flow positive and returning money back to you, the shareholder. Now, make no mistake, the operating business for Amazon is still firing on all cylinders. You have the operating margin for AWS going from 32.9% last year to 39.4% this year, all while pushing 37% revenue growth. The company as a whole reported 20% revenue growth, most of which, as I already mentioned, came from AWS. So, of course, the company is monetizing on the millions and millions, if not billions of dollars getting invested into compute capacity. The difference is, unlike Oracle, both Google, Amazon, and even Microsoft are investing into a business that already exists, already is being monetized, right? As you put Claude or ChatGPT implementations into everyday business operations, into let's say Microsoft Office products like Excel, Word, PowerPoint, what have you. Of course, you're going to have additional computing demand to satisfy these additions to the product. Now, keep in mind, the AI itself is not the product. The AI is an amplifier to an already existing underlying product. That is the difference. Now, how you implement the AI into your existing product is what makes all the difference in the world. So, what you have for Amazon is a negative $7.6 billion cash outflow because they increased capex by 100%. They halted buybacks and M&A just like Google. So again, I mentioned how you implement AI into your business matters more than what you do with that AI. So when you're burning through free cash flow, you're now cash flow negative. That accounts for Amazon and Google. I mentioned before, the hyperscalers in the Max 7, they command those premiums because of their ability to generate and compound on their free cash flow. If you burn all of that free cash flow, things are bound to get worse. Now, let's look at what's happening now, right? You have negative free cash flow, same as Google for Amazon. Now, how do you expand on future capex commitments and future capex guidance? Well, you either have to, one, issue stock, or two, issue debt. In the case of Google, they're doing both. But Amazon right now jumped its debt load from 66 billion last year to 129 billion this year. Google is doing the same, right? So when you take on these amount of debts at a higher yield market, so right now bonds are pushing yields higher, private credit is pushing yields higher, credit lines are pushing yields higher. It doesn't matter if you have a strong balance sheet like Google or Amazon, you are going to have to pay more interest for this debt loads. So what happens when you have negative free cash flow, you don't have the ability to pay the higher interest loads that you're putting on the business. So you either have to, again, issue more stock to pay the debts or issue more debt to repay older debts. Now, from personal finance to corporate finance, that's never a good decision, which is why the credit default swaps for all the hyperscalers are spiking higher. Even Amazon, right? Amazon, Google has arguably some of the strongest balance sheets in the world, and still the bond market is saying we have no confidence that Amazon, Google, Oracle, and all of these companies are going to be able to repay those debts upon the initial agreed upon terms, right? So they're either going to have to take longer or refinance or what have you, right? So the CDS market is voting no confidence on these debt accumulation levels. Now, the big aha moment comes in the financial statement, specifically the income statement for Amazon. So they reported $5.75 in EPS. The headline number grew by 242%. But when you look underneath the surface, they actually reported on a cash basis $1.95. Why is the difference there? Because you have $53 billion of an unrealized equity gain from Anthropic, right? So Amazon and Google, they own a stake in Anthropic. It's a private stake, so you have to revalue it and you have to reprice it mark to market every quarter. So over the past quarter, obviously the valuation for Anthropic has gone up, and that's what they're reporting. So this is not cash, right? It's like your portfolio goes up today by $1 million and you take a screenshot and give that to your bank and say, I made $1 million today. Well, they're obviously going to tell you, no, you did not make $1 million until you sell and realize that profit. Now, what happens here is Amazon and Google are telling you that they made these amounts. And obviously that's not going to happen until they realize the gains and liquidate their stakes on Anthropic and in the case of other companies, OpenAI. So what happens if token economics change, if token price wars start to happen, and by the way, they already are, then obviously the valuations of Anthropic and OpenAI will change. So what happens if the valuations for Anthropic go down? Well, that 195 in EPS for Amazon could very well look like a negative overall, a net loss for the company. What happens to the stock price then? Well, we're going to have to find out. Now, here's the exact bridge on the EPS for Amazon. They reported 575. You take out 380 from the Anthropic stake, you're left with 195. Now, the good news is that they still beat the street estimate of 182. Otherwise, a good number, a good result, which is why I think the stock is up anyways. Now, when you look at Google, Google missed, right? When you take out the Anthropic gains from the EPS, they missed estimates. So that could also be why Google stock is down since earnings. Now, for Amazon, this is still good news, right? It's obviously deceiving. I don't agree with the way they're reporting their earnings, and this is just the way it is, right? The GAAP, or generally accepted accounting principles in the US, allow you to report unrealized equity gains as income. Well, I don't agree with that. That's just the way it is and the way the game is played. But that does bring tail risk down the line for Amazon and Google. So what happens is, if we have a larger re-rate, like I mentioned, if token price wars come in, if further Chinese model competition from open source comes in, what happens to Amazon earnings? Well, if they reported 575 in unrealized gains, the actual cash earnings were 195 per share. You have a small dip on Anthropic valuations. That could give you a net loss per share of $3. And my question is, what happens to the stock then? And I'm not saying sell all your Amazon stock, but if you own it or if you're looking to buy it on any dip, make sure you're okay with this risk and make sure you hedge and position accordingly. Because by next quarter, if things change, if the economics around AI change and the valuations for Anthropic changes, what happens to the stock, right? Are you okay with them reporting a negative EPS number for the next quarter? I wouldn't. Preferably wait until all of those risks are washed out, and then I would consider becoming a shareholder. But right now, doesn't look like it. Now, two beats, 1 minute cash, 1 minute marks. So Microsoft, it looked a whole lot different, and I already covered that within my Twitter account, and I posted a whole newsletter on Offside for this. But Microsoft is a self-funding cash generation, and the operations for capex are funded through positive cash flow. As I mentioned, they spent on the capex from the cash flow and had enough left over to give you, the shareholder, $10.2 billion in buybacks and dividends as well. So they're also improving a business that is already working. They're not making stuff up out of nowhere saying we're going to invest all this capex and see what happens next. They're investing the capex into Azure, into cloud computing, only to amplify the computing capacity so they can adopt AI models like Claude and ChatGPT and even Copilot into their already existing products. So if you use Excel, you could use Copilot inside Excel. You could use Claude and manipulate stuff inside Excel. That is why you need more computing power, not because they're betting on something that's not going to work. If AI fails, they still have all of their commercial cloud business untouched. Now, Amazon, same thing. They're investing into a business that already works and is growing at 37% year on year. The difference is they're investing into it by burning all of their free cash flow. They're taking on debt to do so. And mind you, like I mentioned, negative free cash flow, more debt equals a harder time paying the interest payments on those higher interest debts. Now, that is why I believe Microsoft and the CDS, so credit default swaps, are tight, right? They're the tightest out of the hyperscalers because markets know Microsoft has the ability to repay according to what the cash flow looks like. Amazon does not have that ability, so that's why Amazon CDS are wider than Microsoft. The market is expecting a higher risk of default out of Amazon than Microsoft, and that's why I believe the wedge is in how the market treats those two companies according to that day's regime. So right now, the same DNA that I found in Oracle is found in Google and is found in Amazon. So AI capex is more than cash flow, so now your cash flow negative. Debt, that was defunding or issuing debt closes that gap, which again creates a more or a heavier interest load at higher interest rates with no free cash flow. So then it's like taking on a new credit card to pay off an old credit card. That never turns out well. And the third is the accounting optics. So they're choosing to mislead investors and report aggressive EPS growth when in reality there is none, right? There is healthy growth, don't get me wrong, but when you take out those non-cash items, they're much weaker than they seem. So therefore, the PE multiples that everyone says, oh, we're not in an AI bubble because the multiples are not, overextended. But when you take out those non-cash items, actually the PE multiples are in line with previous valuation bubbles. So that's for another topic. But all I'm saying is that this is not my view. I'm just looking at the numbers and I'm just telling you what the numbers are. But the bond market agrees with me, right? Otherwise, why would the credit default swaps be spiking for all these companies if this wasn't the case? And I know many people are going to say, well, the AI revenues are going to come in 2 years and they're going to monetize. And Morgan Stanley is saying that they're going to be cash flow positive by 2028 again. I don't buy that because you're making a lot of assumptions in a market that is new. It's 2 years old. AI is roughly 2 years old. You don't know what it's going to look like next year. You don't know what competitors are going to come in. You don't know what new models could do as far as token prices and computing power. What if they become more efficient and all this investment turns out negative because you don't need that computing anymore? I mean, there are many questions you should ask around this. And if you are still going to invest into AI, do it through something like Microsoft, where there is fundamentals left. The free cash flow is positive. They're not burning you on issuing stock or issuing debt and all that. Now, you can be a bull, just don't be a blind one. Like I said, size a position on something like Amazon, something like Google, or even Oracle. If you're looking at the discount and saying, I want to buy this stock, size the position accordingly. Make sure you know the risk, right? Set the stops very tight, very volatile or volatility adjusted, and you own the hedge. I believe the best hedge to the AI trade is still software. I mean, we saw the big jump yesterday on the Citadel bailout news, and companies like Workday, Adobe, they went down by over 8%, respectively, right? So what does that tell you? Every time the AI trade goes up, software goes down, and the reason is, or the reason, quote unquote, they tell you is that AI is going to kill software. We know that's not the case. Otherwise, Microsoft would be in the gutter. Otherwise, Amazon would be in the gutter. AI is not killing software, it is amplifying software. So the narrative exists so that Wall Street can hide the fact that for every dollar that goes into the AI trade, 30 cents goes short software as a hedge. So if you want to go long the AI trade, hedge it by buying some software, hedge it by having some software exposure, so that when you have bad days like on Wednesday, those stocks go up 10% plus. Now, you have the read, you have the setup. I broke down the earnings structure for you in the email as well. So go and check out the offsite newsletter. You're going to get all the details as far as the numbers, the implications, the valuation effects for both Microsoft, for Amazon, and for Google as well. What you don't have is what comes next, right? So after the CDS spike, and if the bond market is right and something happens, we have a big credit event in the economy. What is going to happen next, right? So we have a big screen going on for mid caps for real economy halo names that are already doing well, despite of what the AI trade does. I already told you about software, but I think software serves to a further extent as a mirror image to the AI trade. If you want to extend beyond that on names that are unaffected by whatever AI does, I think you're going to find it in the mid caps for halo filters and the real economy. And that is exactly what we're breaking down this week in the offside newsletter. We're doing the deep dives for the company. We're giving you the valuation models, the risks, the rewards, the setups, the entry levels, everything that you need. And of course, if you've been tracking the upside portfolio, we're up 8% on the quarter with a fraction of volatility, right? We're still over 50% cash waiting for this opportunity. So keep that in mind, guys. Go check us out. Go check us out on Twitter. Read our newsletter. You're gonna get at least a few $1,000s of free value in there, as everyone has said to us. So that's all for today, guys. I'll see you next week. Enjoy the weekend, and let's see what the rest of the day brings to us. Good luck.